I don't think we're going to hold 100,000 for very long, much like we didn't hold 20,000 for very long. These are very short-term valuations.
So hello and welcome back to AIBC Summit YouTube channel. I'm here now with one of the biggest YouTubers in the crypto space, Nicholas, founder of DataDash. So Nicholas, it's so great to talk to you today.
Jessica, thank you for having me back on. It's appreciated.
Such a pleasure, and I want to jump straight in because what we've seen right now from COVID-19, the economic impact, the global markets have really taken a hit, and I think what's really interesting is to look at the repercussions that could have on the crypto space and in particular Bitcoin price movement. So I want to jump straight in and talk about Bitcoin dominance first of all and what we're seeing on the markets. What's your impression of Bitcoin at the moment, the price movements that we've seen in the past 7 days, for example? What's your take?
Yeah, so on this topic of Bitcoin and also Bitcoin dominance, I definitely want to split them into two categories. So I think when you address Bitcoin, the thing we have to talk about over the last, week or last 2 weeks was the dramatic sell-off we had where Bitcoin had gone from around $7,000 to $8,000 in a matter of about 48 hours down to $3,800. It was one of the biggest pullbacks we've had in Bitcoin in over 7 years, and it was the second worst sell-side day for Bitcoin in history, as well as the worst sell-off for Ethereum in a single 24-hour period. So, I mean, we had a very significant sell-off, and I think this led a lot of people to questions of, what caused this? Because, I think you probably agree with me, Jessica. If we were looking at the news, there wasn't anything outside of maybe the macro picture, which was what was going on with COVID-19, that could have caused this sell-off. So that's probably what a lot of people pinned as the reason as to why we said that we had the sell-off that we did. But I would say that it's a portion of it. That is one reason, in the sense that people were in dire need of cash during this time period, because anytime we have a global recession, which we're in right now, stocks have been selling off. Even hedges like gold and silver were declining. People are covering positions, and basically as markets tend to knock down as dominoes, they tend to take everything else down with it, and this basically makes everyone force themselves into a long position on cash. If you're selling gold for dollars or selling stocks for dollars or Bitcoin for dollars, you're essentially taking a long or bullish position on the dollar itself. So there was a very dire need for cash during this time, and not very much cash in the system for people to be able to take that out, so people were willing to sell off their assets at just about any price to get those dollars. So that was a portion of why Bitcoin declined. There's two other reasons as well. The second is that there's a lack of spot liquidity. And this is a very fancy term, basically meaning on normal spot exchanges like Coinbase or Kraken or Binance, there's not as much liquidity as there used to be, because most people have taken their dollars or their positions, such as their Bitcoin or Ethereum, and they've taken them over to platforms like FTX or BitMEX, all these different, basically these derivatives platforms that allow you to trade on margin and increase your risk profile. And margin isn't inherently bad, but the issue is that basically if you have too much liquidity on derivatives platforms versus spot exchanges, you get an issue where the spot exchanges are tracking the price on the underlying spot market, and it doesn't take much sell side pressure to lead prices downward. And this really leads us into the third and largest issue that still not many people are talking about, because most people don't look at the public blockchain that's available, the Bitcoin blockchain itself. And that was that there was a Ponzi scheme in the crypto space known as Plus Token that had stolen up to 1% of the entire Bitcoin supply and hundreds of millions of dollars worth of Ethereum. And basically, as they were aiming to exit out of these positions in these cryptocurrencies, they've been waiting months in order to find exchanges where they could sell it. And they ended up most likely selling it on spot exchanges, sparking this almost domino sell side effect where prices just kept going down, where orders continuously were fulfilled on the order book, driving prices down lower. So I think it's a combination of a lot of things. If I've learned anything in markets over the last few years, it's never one simple answer. So your question on Bitcoin dominance, the kind of second portion of it, I would say that the important thing to notice is that we're on the cheaper end for altcoins right now. I think Bitcoin is carrying a lot of the market dominance, so we really haven't shifted too much over the last few months. So as much as I've been holding my bullish position on altcoins, I'm mainly exposed to altcoin positions. I don't believe we're going to start seeing a lot of those gains until the later part of 2020, after the halving event for Bitcoin, and well into 2021. Those are my general kind of time frames for altcoins to really start leading the way. But I think they'll keep up with Bitcoin for the most part.
And something that has been closely examined across kind of stocks, but also the cryptocurrency markets, was there was this initial correlation where there was a market crash last week. Now, would you say that Bitcoin and the other cryptocurrencies, there is a correlation between those and stocks and the traditional FX currencies? Or have we seen that decorrelation yet that the cryptocurrency traders were kind of requiring that we did see?
Yeah, I think it's a good point, Jessica. It's something that we have to keep open to. I have no doubt that Bitcoin still might be seen as a risk on asset. The problem that I see is that people will simply take a day or week's worth of price action and say, see, my thesis is true. Bitcoin and stocks are tied. Or for example, gold and stocks are tied because gold sold off as well, too. So again, it goes back to those points of trying to sit back and say, well, wait a minute, why is it happening the way that it's happening? Why is everything selling off, even the hedges that are supposed to help us during a time of fear? And it was due to one simple correlation between all those assets on a fundamental basis, which was that all of them were trading against the dollar. Right? That's the key thing to keep in mind here. All of the major assets in the world trading against the dollar or major world reserve currencies like the euro, the Japanese yen, or even the Chinese yuan, right? These major currencies, basically people were taking a net long position on currencies. Now, the dollar might have been the ultimate winner, but other currencies such as the euro, again, traded a better position to Bitcoin than they were a couple of weeks ago. You have to kind of look at it in an opposite nature from Bitcoin and the price of these assets, right? If the value of a stock is going down 50%, this means that your euro or your dollar can buy twice as much as it used to be able to. So this means that right now, cash and other fiat currencies are where the demand is at right now. And this question of being correlated to markets, the simple way to put it is a week or a day's worth of price action isn't enough to tell whether or not an asset works in a certain way. The way that I would look at Bitcoin is that over its last 10 years, we've been basically seeing higher significant lows and higher significant highs. And for me, that proves, much like gold over the longer view picture as well, that it's been able to act as a hedge against one key thing, and that is inflation. And I can tell you right now, with central banks across the world, such as the Fed, talking about injecting $4 trillion into the economy and new cash through their quantitative easing 4 program, and along with that as well, the federal government looking to bail out and give cash to everyday citizens, this is going to cause a massive period of actual consumer inflation in this case, and corporate inflation as well, that's going to lead us towards looking for those hedges as investors.
So if we focus on where you are based, which is in the United States, and as you've mentioned there, we're seeing the Federal Reserve state that potentially going to inject even trillions if necessary. You've mentioned inflation there and the repercussions that this could have. What kind of status are you expecting this to have on the United States throughout the rest of 2020, moving into 2021?
Yeah, I think it's a good question. So there's so many different markets to talk about. So I think in the sense of equities, it definitely could provide a bit of relief here for the next coming months. But at the end of the day, fiscal policy and also monetary policy, there's a separation. Fiscal is what the government does in this case to maybe subsidize or bail out certain companies. Monetary policy is when the Fed might inject capital or lower interest rates. You can do all of these things to try to stimulate the economy. But at the end of the day, we can't paint a picture of what's going to come in the next 6 to 12 months unless we know whether or not we're going to find a cure for COVID-19 during that window of time. Plain and simple. I think that those are actually in a system that is driven by monetary and fiscal policy. I don't mind the government and the central banks exercising it now. I don't feel it's where I'd want to have my money in it. That's why I'm very much, positioned in Bitcoin and in hedging assets like gold and silver. But at the same time, at the end of the day, the only way you're actually going to fix this issue and stop the spread of cases and the overwhelming kind of effects on the healthcare system and on the economy, where we're going to have to self-isolate again probably in the next few weeks if we don't really tackle it this time around and come better prepared, then it's a matter of waiting it out and seeing how we're actually going to deal with the crisis itself. You cannot just simply toss money at a problem because we're keeping people inside for a reason. It means that we could lose more lives if we go out there right now. We would overwhelm our healthcare system and possibly make many of our doctors and nurses sick that are already experiencing that in the current environment with self-quarantining in the US and other countries. So to put it simple, it's very difficult. I don't want to act like I've got a 2020 vision on the future. Ironically enough, no pun intended on 2020. But I don't want to act like I know what the future is going to bring. But I know where we need to put our focus, and that's simply on fixing this crisis. I think we need to still go twofold from what we're doing right now. We need to inform the public more about the threats of COVID-19 and really focus on, again, being able to provide, if anything, the monetary relief to average Americans. One of the big issues with the new fiscal policy that the government's putting forward is it's only giving about $1,200, I think, to every American. And I know that sounds like a lot, but it's really not much for the average consumer when you're considering utility bills, providing for your family, providing for all kinds of different daily expenditures, food, healthcare, insurance. You have so many daily costs. And I think what's sad is even though we're taking a step in the right direction at looking at bailouts for everyday people, the problem is it's still much more of an emphasis on corporate bailouts. I think we're still seeing much more kind of lobbying in Washington and still support for more of a corporate bailout rather than an everyday Main Street bailout. So that's the issue, is that this inflation still might end up actually hurting the end consumer more than it's a net benefit, because more of that capital is going to be going towards corporations that are covering bad debts and bad mistakes versus the average everyday citizen.
And you've explained it really well there, that actually lowering of interest rates and also injecting more money into an economy, it might short-term stimulate economic growth, but actually if the economy isn't back to normal because COVID-19 still is an issue, well then we've not fixed the first problem before we've looked at the second. If we look at cryptocurrencies as a whole, I think watching this unfold has been really interesting from a content creator's perspective, because what we're seeing is this subject talk of the next financial crisis taking place, and that'll be the next wave of crypto adoption. And that was kind of a catchphrase that we did hear a lot from as early as 2017. Is this the kind of thing that we're expecting to really trigger and encourage more people to get involved and educate themselves on cryptocurrencies, especially if we are seeing inflation as something that could be an issue for the US dollar, for example?
Yeah, well, just to build on a point you mentioned earlier, Jessica, with the previous topic, it's funny you mentioned that point about how we can't just toss money at the problem. At the end of the day, in the next 6 months, if we don't deal with this on an actual strategic basis on fixing COVID-19, we're going to need another $6 trillion bailout. So that's the whole point there. You're 100% spot on. And in this question of, has there been a general kind of growth and traction for crypto during a time of fear? I would say that we haven't really hit that inflection point yet. I think that you're not only going to need to see more fear, but we're going to need more time to really see if Bitcoin responds well to this. The good news is Bitcoin has recovered a lot of the losses from the recent sell-off. We're basically about a few $100s to about $1,000 away from where we were before the dramatic 24 to 48 hour sell-off that we had. So that's good news that we've actually come back up. But outside of that, I would say this: until we have the halving event and see that supply shock come to Bitcoin, we aren't going to be able to build up that next wave. The good news is it's planned, it's coming in May, and when we get that, we're going to get a much more clear picture as to whether or not Bitcoin can serve as a hedging asset. I think it's a matter of that halving event, because the halving event can't really be priced in. The vast majority of the world neither understands Bitcoin's monetary policy, but also doesn't know or understand about what Bitcoin is. If you own Bitcoin or some form of crypto, you're in less than 1% of the world's population. And again, keeping in mind that less than 1% doesn't fully understand Bitcoin's monetary policy. They just might hold Bitcoin to some degree. So when we get the halving event coming in, on a daily issuance, right, there's a matter of supply and demand economics that's at play, just like gold markets or any other commodity. Basically, you have miners who are producing Bitcoin in this case and selling a fixed amount of Bitcoin on the market that most of them do not hold, or if anything, they use a few mechanisms to possibly sustain their holding for a while. But a good chunk of miners are selling directly on the market. They're providing daily sell-side pressure, not even including the other sellers on the market who just might be closing out positions. So what buyers need to be able to do is outweigh the sellers and also the miners who are issuing the new Bitcoin each day. So when the halving event comes into play, a lot of that sell side pressure is going to drop, because the new issuance of Bitcoin is going to be cut every 10 minutes, meaning that on a daily basis, buyers are going to have to only mitigate a certain amount of sell side pressure. So if the general demand stays the same and the halving comes into play sometime in May, it's going to leave basically on a multi-day, multi-week, and multi-month basis this inefficiency between the supply and demand, where prices have to rise, because the demand will likely not change. And if anything, if price is rising, demand will grow. We've seen that historically with cryptocurrencies. And this is why in the last two halving events, Bitcoin has had parabolic rises where it's multiplied multiple times over in valuation after the halving. So it's very important to understand the halving is not priced in, and we have to wait and see what's going to happen after the halving before we can really know if Bitcoin will act as a hedge. It's in the perfect time to test it. I'll say that.
And Nicholas, you've been creating content since around 2017. So do you have a price prediction for the build up to the next halving? I know you've said that it's not priced in and you can't really predict where it's going to go, but do you have a target price in your mind?
Absolutely. For me, I think one of the big evens, if you look at most cycles, Bitcoin topped out back in 2013 and 2014 around $1,100, roughly speaking, the big even of $1,000. And then after that, it went on to go 20 times higher from its previous high at 20K in 2017. And I think this time around, we went to 20 times multiple from the two previous highs. I think this time around, we're going to get a 5x from the previous high, which is going to be a very big even, six-digit value of $100,000. Now, I know to many people that sounds crazy. It doesn't seem very fathomable, but there's a few things to keep in mind. I don't think we're going to hold 100,000 for very long, much like we didn't hold 20,000 for very long. These are very short-term valuations. But along with that as well, $100,000 for Bitcoin is not that much in the sense of overall valuation for the Bitcoin network. That would help us get to over $1 trillion valuation for Bitcoin alone, and I bet the broader crypto market could see $2 trillion in value, as Bitcoin dominance will probably have dropped by then. But the most important thing to note here is if $1 trillion still sounds like a lot, I always tell people to look at markets scale. Again, focusing on market capitalization, which is taking the overall supply of a given asset and multiplying it by its market price. If we take a look at gold markets, for example, gold is a $10 trillion market right now as we speak. That's not, factoring in that it will probably grow going into times of fear to a $15 or $20 trillion market. But if we take a look at global equities and the global property market, we've got an even bigger picture, right? Global equities, I think just in the United States alone, equities topped around a valuation of $30 or $50 trillion. And if we take global equities in, that nearly doubles to nearly anywhere from 80 to 100 trillion, given the time and the market valuation. So we have to talk about, the sheer fact that crypto right now at around $180 billion valuation at the time we're recording is such a small, minute market that has that room to grow multiple times over in valuation while we're going into a time of fear. So again, I think the halving of it is going to be the catalyst for that. And afterwards, we'll have to see if the world really does take on Bitcoin as a hedging asset rather than just a tool to speculate and trade on.
And is this the kind of thing that if you are a cryptocurrency trader or a cryptocurrency holder, you should be closely watching the economy as a whole, how things are moving outside of the cryptocurrency markets? Because are they in correlation? Is it something which, at the moment that it is such an uncertain time, we should see how things move?
Jessica, that's really the question that I always try to get people asking, because to your point, whether they're correlated or not, the key thing at the end of the day is in the sense of like direct correlation and price action. All these markets do play a role into one another. Bitcoin cannot go up unless it gets what's known as inflows, and that's a very finance way of saying, is there going to be new money coming into the system, right? Bitcoin won't go up, and that's the same as to why stocks have gone up. Stocks have only gone up because the Fed injected quantitative easing, which was new capital into the banking sector, and basically bailed out a lot of major commercial banks through fiscal policy under the federal government. So it's important to understand that, yes, no matter if there's a direct correlation or not in these asset classes, people could agree or disagree on that. It is so important to follow the macro perspective. What's going on in stock markets? What's going on in markets that might seem boring, like bonds or treasuries? And also understanding what's going on in commodity markets, such as gold and silver. Because when you understand things on a full-scale picture, you not only find how things are tied together, but you're not going to miss opportunity elsewhere. Crypto isn't always in a good position, right? Sometimes, for example, if Bitcoin went to 100K, I'm much more likely going to be looking for opportunities elsewhere if, as an investor, to grow my capital after Bitcoin's gone to 80 or 100K, right? And that's the key thing to keep in mind. You should be as open to new markets as possible so you have unlimited opportunities elsewhere, so you can look for the most favorable opportunity to grow your capital.
And is there any other altcoins at the moment that you are keeping a close eye on, any projects that in particular you might find interesting or engaging? I know it is an uncertain time and it is a volatile time in the space, but there might be potentially some projects that you think have some interesting potential here.
Yeah, I would say, Jessica, my number one kind of focus right now is the decentralized finance space. And a lot of these projects are built on top of Ethereum, the second largest cryptocurrency network. I would say that there's a lot of different projects that have got me excited. One of them is Kyber Network. Kyber Network is basically aiming to help lead the way in building the base liquidity pool, basically the base way that people can bring crypto assets into one central ecosystem to process decentralized trades. So we basically right now are getting to a point where in the next Really right now, actually, we're able to make trades without the need of a centralized exchange or some kind of bank or broker dealer. So this is a really extraordinary time where we can be able to reduce the costs of trades, and we can do so in a trustless way. One of the big issues, just to tie in traditional markets, to your point, Jessica, earlier, one thing we can learn from traditional markets that we're seeing right now in commodities is we're seeing in gold markets, there's a huge discrepancy between the actual price of physical gold versus a paper ETF or like a stock-based product to invest in gold. Because for the last few years, we've had to deal with an issue of what's known as rehypothecation. And rehypothecation is when you use the same asset multiple times. To basically put it simple, for these ETF notes that were generated, there was 100 notes generated for every 1 ounce of gold. So there should have been 100 ounces of gold backing up, but there's really only 1 ounce per 100 notes. So a lot of people who thought they owned gold really don't own gold at the end of the day. Whereas on a blockchain-based network like Ethereum, if I trade a stable coin such as USDC, or if I own some Ethereum or some other kind of ERC20 token, in this case on Kyber Network, when I exchange that with you, I know it's settled on-chain that you own those assets. There's no promise that it's in some vault somewhere. You own that stable coin or you own that specific type of cryptocurrency. And that's why Kyber Network and decentralized exchanges that are like Kyber Network are so valuable. So KNC is the token. It's the Kyber Network coin that basically helps to basically govern the network as they're working towards building a government around it. But anyways, long answer I know probably to that, but Kyber Network is one of them. Another one as well that I'm interested in is Chainlink as well. So Chainlink is, or basically LINK, Chainlink is aiming to help bring in the solution of oracles to blockchain networks. So basically the issue is networks like Ethereum have smart contracts, which can be very valuable, but they're not very valuable if they can't basically navigate or communicate with the outside world. And that's what oracles help to do. They serve as what's known as a middleware solution between the Ethereum network and traditional data sets. So basically real world data on markets, on certain events happening. And when we can pull that data into smart contracts, we can build basically autonomous agreements that we don't have to rely on a third party to settle in this case. So let's say, just to do a very simple example, let's say you and I, Jessica, we wanted to do a bet on like a sports game of some sort, right? We could basically make a betting contract in this case where we both lock up a certain amount of Ethereum or a certain amount of stable coins into the contract, and we use Chainlink to communicate with the outside world to pull in real world data as to what actually happened. So let's say you betted on a team and I betted on another one. It ends up that you win. I made the wrong bet in this case. And basically when that data is pulled into the smart contract, it'll automatically settle and submit all of the winnings over to you as well as your original principal or your original money that you put into the smart contract. So those are two projects that I would really recommend. There's a lot of other ones. I don't want to spoil too much, but I recommend people go down the rabbit hole and study what's going on in the DeFi space and what's more specifically going on Ethereum. There's so much exciting things going on.
And this is the perfect time, actually, I think, in an unforeseen circumstance where a lot of people are at home. They have a chance to really sift through some video content like your channel. They have a chance to look through some interesting projects that they might not have been able to stumble upon, go down the rabbit hole, as it were. Nicholas, it's always great to get your insights. Thank you so much. Stay safe in the coming weeks as well, and we hope to hear from you again really soon. Thank you.
Jessica, all the same to you. Take care.
Thank you. Well, that's all for myself and Nicholas. We would love to hear how you found this interview, so share your thoughts in the comments below and see you all very soon.